You can lose your job at 50 and still be unemployed at 51. The reason has nothing to do with how hard you are trying. It is that the math of who gets called back changes the year you turn 49. In the next 6 minutes, you will know exactly what 12 unemployed months at 50 cost you, and the one move that decides whether you recover in a year or lose a decade. The part nobody warns you about is this. The money does not break in month 1. It breaks in month 7, after the severance runs out and the unemployment checks stop, and your phone still is not ringing back. You are 50. You make $180,000 a year. On a Tuesday, your manager calls you in and uses the words restructuring and transition. You get a severance package, and your colleagues tell you you will find something fast. Then a month goes by, then 6, then 12. The check from your last paycheck cleared back when the news still felt fresh. Now you are staring at the same screen, refreshing the same job board, watching your savings line move down one notch at a time. Here's the actual math on a year off at 50. Your $180,000 salary nets out to about $10,500 a month after federal, state, and payroll taxes in California. 12 months of that lifestyle costs you $126,000 just to stay where you already are. There are no upgrades, no extras, no new car, no vacation. That is your survive number. Now look at what comes in. Severance for senior professionals at the director level averaged 15 weeks in 2025. At your pay, that is roughly $52,000, taxed in one lump that pushes you into a bracket you have never seen on a paycheck. Unemployment insurance in California caps at $450 a week for 26 weeks. Added up, that is $11,700, also taxable. So a little under $64,000 lands in your account during the year. Then look at what goes out that was not there before. The biggest new line item is COBRA. The same family health insurance plan that cost you $300 a month at work costs $2,000 a month on your own. That is $24,000 on top of the $126,000 you already owed to stay alive. The shortfall is about $86,000. That is not tightening the belt money. That is real, actual savings account money pulled out and gone. It's not bad luck. It is the math of being mid-career when the system was built to favor the cheaper hire. This is the bridge year. Most people think of savings as a cushion. At 50, with a full year out of work, savings are not a cushion. They are a bridge. The bridge has to be long enough to land somewhere, not just soften the fall. Now run 3 versions of the same year. In the best case, you had 9 months of expenses in cash. Your severance and unemployment covers 6 of those months. You land a new role at month 8 at the same salary, and there is no gap on the resume. You spent about $40,000 of savings, which sounds painful, but it is recoverable in 2 or 3 years of normal saving. You walk away tired but whole. In the worst case, you are in the 38%. That is the number nobody on a finance channel uses, and it should be the headline statistic of the rest of this video. 38% of unemployed Americans aged 55 and older are long-term unemployed, meaning out of work for more than 6 months. That is roughly twice the rate of every other age group. So you go 9 months, then 12, then 18. You tap your 401k, and then your home equity line. By the time you re-enter the workforce, you have eroded more than $200,000 of compounding from your retirement number. You also re-enter at a 15 to 25% pay cut, which becomes your new ceiling for the rest of your career. The bill for that 1 year does not show up in the year. It shows up at 67 when you realize you cannot retire. In the most likely case, you are somewhere between. You land a job at month 11, the salary is 12% below your old one because by month 11 the bank account is screaming and the offer in front of you is the only one in your inbox. You took it because waiting was no longer a financial option. Recovery is 4 to 5 years of clawing background. You did not lose by being lazy. You lost it by being expensive at the wrong moment in your career. It's not your effort. It is the structure of the numbers. Here is the part the system already knows that you probably don't. The IRS has a rule called the Rule of 55. If you separate from your employer in the calendar year you turn 55 or later, You can pull money from that employer's 401k without the 10% early withdrawal penalty. You still owe income tax on the withdrawal, but the penalty is gone. The IRS wrote that rule because they knew exactly what happens to senior workers between 55 and 65. There is a second rule. If you collect unemployment for 12 consecutive weeks, you can pull from your IRA penalty-free, specifically to pay your health insurance premiums. The system built that exception because it watched the same scenario happen so many times it became standard procedure. These rules are not loopholes. They are doors the law built into the building because too many people kept hitting the same wall. Knowing the door exists is the difference between burning your retirement and bridging 12 months without scorching it. It's not a personal failure, it is a structural feature of the labor market, and the tax code already admitted that out loud. Tonight, before you go to sleep, pull up your bank and brokerage statements. Add the cash, add the taxable accounts, then divide by your real monthly cost of living, not your if I cut back number. The answer is how many months you actually have. That is not your goal, that is your number. If it is under 9, you do not have a bridge yet. You have an extension cord, and at 50, an extension cord will not reach where you need to go. If you found this useful, hit like, subscribe, and turn on notifications for more simple explanations.